All right, welcome to this explainer. Today, we are diving into something that is quite literally reshaping the world right under our noses. Have you ever walked down your street or, just turned on your tap and wondered who actually owns the infrastructure that makes modern life possible? Well, today, we're unpacking a really fascinating phenomenon, the rise of the asset manager society. Now, I know it sounds a bit dense, but we're going to break it all down so you get a crystal clear look at how massive global finance is quietly moving right into your neighborhood.
Let's kick things off with a pretty wild example, just to ground this. Think about your local water supply. If you live in London, for instance, your water comes from Thames Water. But who actually owns that utility? Well, the answer is probably not what you'd expect. For years, a massive Canadian pension fund called OMERS, that's the Ontario Municipal Employees Retirement System, was actually the largest shareholder. So think about that. Everyday people in London paying rising utility bills might have literally been funding the retirement pensions of municipal workers an entire ocean away in Canada. It's just a perfect illustration of how global capital flows connect us in these incredibly hidden ways. Section 1. The Invisible Landlords.
So, what exactly is an asset manager society? Well, according to geographer Brett Christophers, who actually coined the term, it's a world where financial intermediaries act as the ultimate owners of the real assets that sustain human life. We're talking about the big stuff: housing, energy, transportation, healthcare. Massive firms like Blackstone, Brookfield, and Macquarie raise capital from institutional investors, like those pension funds we just mentioned, and they buy up the basic means of social functioning. Basically, they've become the invisible landlords of our everyday existence.
Section 2. From Stocks to Streets.
Okay, to really wrap our heads around this, we need to draw a huge distinction. When you hear about giant financial firms, your brain probably jumps to passive management. This is like a Vanguard index fund tracking the S&P 500. They're essentially just holding paper assets or shares in publicly traded companies. But what we're focused on today is real asset management. This is when a firm directly owns and controls a physical, tangible asset. They are the ones deciding if the rent goes up, who buys the electricity, or if that toll on your commute increases. They aren't just trading stocks on a screen. They have active, real-world control over a physical property.
So let's follow the money here and see how this business model actually plays out. First, institutions like those pension funds provide a mountain of capital. Second, the asset manager takes that cash and buys the physical asset. Let's say an apartment building. Third, they collect the user fees or the rent. But step four is the real kicker. The asset manager typically flips that asset just a few years later. See, they use these things called closed-end funds, which are specifically designed for short-term investment windows, usually around 7 to 12 years. Christophers calls this an intense churn. The goal here isn't to be a long-term, friendly community partner, right? The goal is to maximize returns and then sell the asset for a capital gain to the next buyer.
To put this macro concept into perspective, let's look at a pretty crazy story out of Chicago that shows how this directly impacts everyday city planning. So the city of Chicago leased its parking meters to an asset manager, and the contract actually included a non-compete clause. Down the line, when the city tried to permit a new parking garage nearby, the asset manager sued them for $62 million. Because the city was legally bound to protect the asset manager's revenue stream, it suddenly found its hands totally tied when trying to implement basic urban planning, like building new bike lanes or bus routes. The financial portfolio was literally dictating the physical layout of the city. Wild, right?
Section 3. Buying up the block.
Let's zoom back in from massive city infrastructures and look at a micro case study. Researchers at the University of Colorado Boulder tracked property records in the single-family housing market and identified a massive shift. Get a load of this data. Between 2011 and 2021 in Mecklenburg County, North Carolina, 7% of all single-family homes sold were purchased by institutional investors. And if you zoom in specifically on the neighborhoods these firms actively targeted, that number jumps to 12%. This isn't just some random person buying a second home. It is a highly systematic acquisition of suburban real estate.
And the data proves this wasn't random at all. These firms absolutely blanketed very specific suburban block groups. It's like a giant coordinated sweep. They use sophisticated algorithms and all-cash offers to aggressively target homes in the starter price range. And they often use dozens of obscure subsidiaries to completely mask the true scale of their buying sprees.
Here is where the data reveals a really stark pattern. The researchers found a very clear demographic focus to this targeted buying. According to the study, 77% of these institutional transactions occurred in neighborhoods with an above-average Black population. So the numbers show a huge disparity in targeting, revealing that these investment strategies are heavily concentrated in very specific demographic areas.
Section 4. The neighborhood impact.
We know who is buying and we know where they're buying. But what does this rapid shift in ownership actually do to the people living on these streets? Well, the most immediate hit is to home ownership itself. The researchers identified a 4 percentage point decrease in home ownership rates, specifically in the Black neighborhoods targeted by these institutional investors. This is a huge deal. Over 80% of the homes bought by these investors are converted into permanent rentals. And since home equity is the primary driver of wealth creation for most American families, the researchers point out that this trend is directly eroding the pathways to long-term wealth generation in these specific communities.
But the impact actually spills over far beyond just the buyer and the seller. The CU Boulder study documented what they call social spillovers, basically a ripple effect. When an institutional investor buys a home on a block, transacted homes within just 250 feet see a 2% decline in property value. The researchers also found a massive 39% decrease in building permits, which points to way less investment in property upkeep. On top of that, there's an 8% increase in nuisance code violations, a 1% decrease in registered voters, meaning civic engagement drops, and even slight upticks in local crime rates. The data paints a pretty unmistakable picture. Shifting from long-term homeowners to short-term institutional rentals fundamentally alters the entire social fabric of a neighborhood.
Section 5. What happens next? So where does all this leave us? Well, communities are definitely not taking this sitting down. The study notes that homes located within homeowners associations, or HOAs, are actually less likely to be purchased by these investors. And why is that? Because some HOAs have started fighting back by implementing waiting periods. Basically, they require a new buyer to live in the home for a certain number of years before they're allowed to convert it into a rental. And on a larger scale, lawmakers are paying attention too. There's proposed legislation at the federal level, like the Stop Wall Street Landlords Act, which aims to deny certain tax benefits to large investment firms holding massive portfolios of single-family homes.
To really wrap our heads around the sheer scale of this societal shift, there's this incredibly powerful quote from Brett Christophers. He says, "Asset management makes all of our lives part of asset managers' investment portfolios. Whether it's the toll road you drive on every morning, the water you drink, or the house right next door, the mechanisms of global finance have literally moved off Wall Street and right onto Main Street. It's this deeply intimate form of financialization that is now touching the basic building blocks of our daily lives."
Which leaves us with one massive question to chew on. How is this changing landscape of ownership going to shape the future of your hometown? Next time you see a for sale sign get pulled down or a new city infrastructure project pop up, ask yourself, who is really holding the keys? Thank you so much for joining me for this explainer. Keep asking questions and keep looking closely at the world around you.